Fed's going to cut by the end of this year and taper its balance sheet. That would seem to indicate you have a bleak view of the economic prospects for the world, right?
Well, right now, I think when you look at the Japanese 10-year yield negative, you have the German 10-year at 9 basis points.
9 basis points.
The U.S. 10-year is back to where it was January 4th. Real rates in the U.S. and the 10-year back to where they were in August. The bond market is telling you that they're concerned about the direction of global growth. Now, I'm optimistic that we're going to get a trade deal, and hopefully that clears up of a lot of the economic cloudiness in the eyes of CEOs. But just looking at the message of the bond market, they're more worried about the situation and that China is slowing irrespective of a trade deal. So that needs to be reconciled, the direction of the stock market and what's happening in bonds. But if this slowdown overseas starts to infect the U.S. to a greater extent, the Fed could cut rates by year end. Ryding
must not be long stocks because you're mad that the Fed wimped out so quickly, and you think that at full employment we deserve some more hikes. I think is that too simplistic?
No, I think that's fairly close to it. Look, one of the principles of monetary policy is that changes in policy and how policy is being conducted is supposed to be transparent. But what it's like watching a performance of Don Giovanni in a language you don't understand with lots of plot twists, and you're sat there scratching your head as to try and figure out how this is unfolding. So in December, the Fed said this year's growth is going to be solid, inflation is going to be around 2%, the unemployment rate is going to fall, we think 2 more rate hikes are going to be appropriate, and the balance sheet's on automatic pilot. And now we're not willing to say whether the next move in interest rates is an increase or a cut. And we're probably going to wind up the balance sheet sooner rather than later, maybe by the end of the year. And Mester joined Dudley in that kind of picture for the balance sheet outlook. And so the thing is, what's the moral of monetary policy here? What is driving monetary policy? And in the end, it's either the whims of the stock market or it's political pressure, or at least that's what it's.
Are we stuck, do you think, unable to raise rates? Did they just get scared at the market reaction and we're stuck and unable to get out of this 10-year easing period? Or?
I think we are until the data force them to do something different. And that's the problem. They're not getting ahead of the story. So as a result, they'll wait. I think we're going to see higher inflation. I think monetary policy is still accommodative. Wage pressures are still rising. And so I think that will translate through to higher inflation.
Do you agree with any of this?
Well, I listen to a lot of company conference calls, and a lot of companies are trying to raise prices. They're dealing with higher transportation costs, higher raw material costs, higher labor costs. So I don't think people should be so nonchalant with this inflation story. Oh, inflation's not a worry. I can afford to be flexible. My issue with the Fed at this point is when they keep talking about financial conditions. You can overlay a chart of the Goldman Sachs Financial Conditions Index with the S&P 500. So where the S&P 500 goes, that's where financial conditions go, even though the Fed thinks it's some externality affecting financial conditions, and not their own policy.
John Williams himself said that inflation's actually a little below what they would like to see it. Does that concern you, given his status at the New York Fed now?
I mean, the core CPI, well, they like to look at PCE, which is obviously always running below CPI. I have a problem with PCE because a lot of it is the reimbursement rates of Medicare and Medicaid that are price fixed that help to suppress that relative to CPI. But core CPI is up 0.2 5 months in a row.
I feel bad for the Fed because it's like a half-empty, half-full argument. You can, no, with the stock market, you either say, oh, they're held hostage to the stock market. All they care about is the stock, and the traders are dictating what they do. But then it's the only leading indicator. It's the only leading indicator.
They tied their mess to it.
Themselves hostage to the stock market.
But isn't that what they should use to forecast the future instead of lagging indicators?
And you're not talking about every 100-point drop. You're talking about what you see in the bond market.
Couldn't you get an idea about the future from the stock market instead of?
But there's the famous quote like the stock market has predicted 11 of the last 8 recessions.
Yeah, but they predicted 0. The Fed has predicted 0 or 10. They're even worse than the stock market. Right?
But now, how do we? What are decision policy now? Where we're now out of the bear market that we got into on December 24th. The stock market's up 20%. Now, what's the next move? And if you're constantly...
Well, what if the next move is let's just wait and see the data? And there's been so much confusion. We're not saying this is what's the rest of the year, but we're going to wait and see what happens. My guess is they're off. They're not going to do anything for at least 3 to 4 or 5 months.
I don't see anything before June, but I do see them hiking rates in June.
Hiking rates in June.
I hope they do, because that means the data gets better.
Sure.
Because if they don't hike in June and they end up cutting by year end, we know why, unfortunately.
Right. Things are worse.
Right.